All right, let's get comfortable and dig into the financials of an American icon, La-Z-Boy. Their latest quarterly report just dropped, and, it tells a really fascinating story about some big strategic shifts and pretty mixed results. We're going to break it all down, looking specifically at what the company's CFO had to say. So what do the numbers really mean for their future? Let's find out. So right off the bat, what's the big number everyone's looking at? $522 million. That's their total sales for the quarter. Now, that's actually a slight increase over last year. And you've got to remember, in a market that the company itself is calling choppy, just holding your ground, let alone growing a little, well, that's the first piece of the puzzle. But the real question is, where did that cash come from? And more importantly, how profitable was it? So here's our game plan for today. We're going to start with the big picture financial snapshot. Then we'll dive into the three completely different businesses that are hiding under the La-Z-Boy umbrella. After that, we'll decode their profit margins, and finally, we'll look at the huge bets the company's making on its own future. Okay, first up, let's get that 30,000-foot view. Before we get lost in the weeds, we really need to understand the consolidated numbers. What does the performance of the entire La-Z-Boy Corporation look like? And boom, this is where the story gets really interesting. Sales ticked up, sure, but their profitability, it just held flat. The adjusted operating margin landed at 7.1%, which gave them earnings of 71 cents per share. Now here's the kicker. That's exactly the same as last year. So wait, they sold more stuff, but their profit per share didn't budge? That is a huge clue that something else is going on under the hood, and we need to pop it open and take a look. And here we go. This is where we find the real action. That one big number we saw earlier, it kind of masks what's really happening. See, La-Z-Boy is basically three different companies living under one roof, and each one of them had a wildly different quarter. So let's break them down. Okay, this table tells you everything you need to know. First, look at retail. These are their own stores. Sales are up a little bit, which is good, but look at that margin drop. It fell almost 2 full percentage points. That hurts. Then you flip over to wholesale. That's them selling to other furniture stores. Now that's a good story. Sales up, and their margins jumped pretty significantly. But then there's Joybird, their online brand. And yeah, it's not a pretty picture. Sales dropped 10%, and their losses actually got bigger. So why the roller coaster ride across the company? Well, for the retail business, that margin dip was caused by something called fixed cost deleverage. Just think of it this way. Your store rent and your employee costs are pretty much the same, but if your sales don't grow fast enough, those fixed costs start to eat away at your profit. It's as simple as that. Meanwhile, wholesale just got more efficient. And poor Joybird? Well, when your sales volume drops, it just gets a whole lot harder to cover all your costs. All right, now that we've seen the different parts of the business, let's zoom in on the company's financial engine room, its profit margins. This is where you see just how well La-Z-Boy turns things like wood, fabric, and labor into actual profit. There was a real battle going on with their gross margin this quarter. In one corner, you had some good news. The cost of raw materials went down, and shipping from overseas got cheaper. Awesome. But in the other corner, you had higher supply chain costs and this weird thing the CFO kept mentioning called friction costs. And after all that fighting, they barely moved the needle. A tiny, tiny increase. They basically worked their tails off for a tie. So what on earth are these friction costs? It sounds complicated, but think of it like this. La-Z-Boy is in the middle of this massive project to shrink its distribution network from 15 centers all the way down to just 3. Imagine you're doing a total renovation of your kitchen. It's going to be amazing when it's done, right? But for a few months, you're paying for the new kitchen and you're spending a fortune on takeout because you can't cook. That extra money you're spending on takeout, that's the friction cost. It's the temporary, inefficient, painful costs you pay now to be way more efficient later. Okay, but here's the thing. Even with all those friction costs dragging them down, there was a huge bright spot. Check this out. The company generated a really strong $50 million in cash from its operations this quarter. That is a very healthy number. And if you're thinking, okay, is $50 million a lot? How about this? It is 3 times what they generated in the same quarter last year. No, not 30% more. 3 times more. That's not a small improvement. That's a dramatic leap. It tells you they're getting really, really good at managing their cash and inventory, and that cash, it gives them a ton of flexibility for the future. So this brings us to the grand finale. All these numbers we've been looking at are actually the result of a very deliberate strategy. So let's talk about the big bets La-Z-Boy is making to shape its own future. The whole thing really boils down to one simple, powerful idea: focus. They're trying to sharpen their focus on what they are truly great at, their core North American furniture business, and just get rid of everything else that's a distraction.
So how are they doing it? Well, they're making some absolutely huge moves. On one hand, they're buying more of what works. They just made the largest independent store acquisition in their entire history, grabbing a 15-store network in the Southeast. But at the same time, they're cutting what doesn't work. They're getting out of the case goods business, things like wooden tables and dressers, and they're even closing a manufacturing plant in the UK. It's all about getting lean and mean.
Okay, so they're buying some businesses, they're exiting others. The obvious question is, what does that actually do to the bottom line? What's the net financial impact of all this shuffling? And this slide right here, this is the heart of their entire strategy. It's a massive trade-off. They are fully expecting to lose about $30 million in annual sales because of these changes. Yes, you heard that right. They plan to sell less. But, and this is the whole point, in exchange for that smaller top line, they project a huge boost to their overall profitability. They are making a very conscious choice to become a smaller, but significantly more profitable company. That's a bold move. So, with all that in mind, what are they telling investors to brace for in the immediate future? Let's take a quick look at their official guidance for next quarter. For the next quarter, they expect sales to be pretty steady, but whoa, look at that operating margin. It's forecast to drop down to between 5 and 6.5%. So why the dip? You guessed it. It comes right back to those friction costs. Remember the kitchen renovation? Well, this is them paying for all that takeout. It's the short-term pain they know they have to go through to get that long-term gain. And that leaves us with the really fundamental question here. La-Z-Boy is making all these bold, clear, and frankly smart moves to become a leaner, more focused, more profitable company. But, and this is a big but, they're doing all of this in a really tough economy where people are thinking twice about big purchases. So the ultimate question is becoming a more efficient company enough to spark real growth, or is the challenging market just going to hold them back anyway? That is the story to watch.